most central bankers, if you ask them, if is one of the reasons you exist to fund the sovereign, almost always they would say no. So basically, fiat technology greatly boosts seigniorage, which allows the government to do things that they might not otherwise do. And so by basically just kind of running a deficit and then later monetizing some of it, it's something now we're talking about the deficit, but now all those people that made those decisions are out of office, there's no consequences. And so what the basement does, and fiat currency in particular does this, is Bitcoin at 2 trillion market cap is completely irrelevant for nation states being able to engage in war. We live in a world where
Lyn Alden is a top-tier investment strategist and best-selling author of Broken Money, where she unpacks the evolution of money through technology.
With her unique blend of electrical engineering expertise and deep financial knowledge, she delivers actionable insights to over 100,000 investors every month, helping them build wealth and achieve financial freedom.
there's really no reason to hold currency or bonds other than either between the voters and the politicians. The fiat currency debasement is kind of the release valve. Bonds have been a kind of safe haven for a shorter period of time than people think, because if Bitcoin's a really big global settlement network and it's really liquid in multiple currencies and you're a central bank, why would you hold dollars and treasuries, which are debasable and confiscatable, when you could hold Bitcoin and you can still move it around as quickly as you could treasuries? Part of my phrase, nothing stops this train, is basically saying two things. People often focus on the first half, which is deficits are not going to go down meaningfully anytime soon. So nothing stops the deficits. But on the other hand,
Hey guys, I just wanted to let you know I published a new book, The Bitcoin Enlightenment, co-written with my buddy Daniel and none other than Mexican billionaire Ricardo Salinas. It's a deep dive into the monetary system and its future. In it, we make the type of connections that go beyond what you'll hear from your average Bitcoiner, MMT advocate, or macro pundit. So grab your copy on Amazon today. You'll find the link in the show notes. And now on to today's show. Hey guys, welcome back to Less Noise, More Signal, another show. And I'm very pleased to welcome back Lyn as well. We already had you on the show and it's great to have you back. Hi Lyn.
happy to be back. Thanks for having me.
Yes, great. Yeah, it's always amazing. You're probably one of the most sought after guests, I think, with so many podcasts, and it's just a privilege to have you on. So great that you made it. Today's discussion, I sort of want to frame it in a couple of topics, or a couple of ways, so to say. One is definitely the book that we just published, our own book that we published. I did it together with a colleague of mine, and then also with Ricardo Salinas, the Mexican billionaire and entrepreneur and Bitcoin believer. So that's definitely great. And you've been so kind to write a recommendation as well. So that's very much appreciated. And
It's a great book, and congrats for getting it to the finish line. And I definitely recommend people check it out.
Yeah, great. Thanks a lot. I mean, in the end, with your book, Broken Money, which is also available from the Safe House, obviously, you've been a great inspiration for us. And that's why we got writing in the first place, just to sort of maybe expand on some of the topics, so people can learn ever more about the system of Bitcoin and what's going on in today's world. So I want to structure this in the way that we maybe take a few topics from the book and then also tie to the current things that are happening in the world. But maybe my first question would be regarding the book, that you've written. Just out of curiosity, what is like your main learning when it comes to having written a book?
I think the main learning is whenever you are writing something, whether it's an article or especially a book, just because the bar is higher, educating makes you learn it better, right? So if you're just kind of learning something on your own, there's a tendency where you'll get like 80% of it, and you'll be like, and the other 20% is kind of hard, and you're like, I got what I need. It's it's good enough. But if you're teaching it to someone else, you really are now have a strong catalyst, a strong incentive to make sure you master that other 20% as well, because you want to dot all your I's and cross your T's and make sure you're doing it properly. And so kind of like how going to university, even though the research might be available online, having to do a test is a good incentive to do it well. Well, educating is also arguably an even better incentive to do something. So it kind of forced me to dig into little corners that I might have otherwise missed. And I think, I mean, the biggest takeaway from me was like probably how speed matters for money. Um, that was one of the foundational things that made me decide to write the book in the first place because I resisted writing a book for many years because I'm like, I don't want to write a book for the sake of writing a book. As you know, it's incredibly tedious, um, tons of work. And I was like, well, I'm only going to write a book if there's very strong inspiration for why the book would be differentiated. But eventually, a handful of kind of key themes fell into place, and I think the final one that kind of pushed me across the finish line to actually decide to write it was, wanted to talk about the importance of the kind of the era of telecom, the era of the telegraph and everything that came after it, and how that impacted money because I had not seen that discussed enough.
Yeah, that's a great takeaway. Actually, I think that many people got from your book exactly the importance of speed and how this really like maybe also is somewhat a benefit when it comes to fiat, so to say. Which many people nowadays maybe also miss. When they talk about the benefits of that system, and then I guess. As always, there's drawbacks, there's advantages, but speed definitely being one that Fiat solved, I guess. Yeah, technology wise, that's for sure. I
Yeah,
mean,
I
yeah,
think the way I'd put it is basically that, by creating a really big mismatch between transaction speeds and settlement speeds, which the telegraph and subsequent technologies did, it basically gave a lot of power to anyone who's running a really big centralized nation state endorsed ledger. So there's certain
mm,
technologies that when they come out, they power one side or the other, kinda like how the discovery of gunpowder was really bad for, like, castles, right? There's certain kind of things that happen, and basically this technology, just shifted a lot of power to those that run those ledgers, which people can debate if that's a good thing or a bad thing. I don't think I don't think it's a great thing. But basically, that's an era that we kinda had to go through until more recently when they finally figured out how to make fast settlements with Bitcoin and,
mm.
that type of technology.
Yes, for sure. No, that's definitely a great point, and I think we even quoted you on that specific point in our book ourselves because we wanted to develop on that idea as well. I mean, another core idea that we had in the book, in our book, is sort of, and that's another, I would say, avenue or angle that sort of Fiat solved for, and it is maybe even said a little sarcastically, but it's really like the financing of governments, sovereigns, the states, because if you look throughout history, I think you would probably agree that, yeah, like central banking and also banks in general have always been a primary force in financing governments, and so even if you look at the Bank of England, which became sort of the role model of all central banks, if we want to put it that way, like its original purpose was really financing the government. And so my question would be, to what extent is this raison d'être, or this purpose still defining modern central banking?
I think it's still one of the key things that's driving them, probably one of 2. I mean, the other one is basically that in the modern age, the foundation of what fiat currency is the liability of a central bank. So I mean, they're the foundational ledger that they currently run on. And they obviously control the size of that ledger. They normally increase it, they can occasionally decrease it. And so that's kind of their first purpose. And then the second purpose is they want to run that own ledger themselves rather than rely on a ledger they can't control, like gold or Bitcoin or something. Because if there's a problem with the amount of debt units in the system, then rather than letting the debt units go down, which can include government bonds, basically instead of letting them default or otherwise have a disorderly thing, they just print more units. And so that's still a key thing is funding the sovereign. And we saw it. I mean, as recently as 2022 during the UK gilt crisis, they had a major problem with their bonds, and the central bank, Bank of England, they had a speech planned about balance sheet reduction, and they literally canceled it and increase their balance sheet to fix the bond market problem. And then, that was a temporary thing. They eventually went to balance sheet reduction after they kind of cleared the leverage out of the system and kind of bailed it out. But the point is, they can step in whenever there's disorderly bond issues, and they can kind of choose what is the release valve going to be. If the government's spending too much money, they can let yields go up. They can let kind of the bond vigilantes and supply and demand kind of flail in the wind for a while. If it becomes too much of an issue, then they can step in and say, well, now we're going to put some of the release valve into the currency itself because we're going to suppress yields. We're going to, print more base money to buy bonds, whatever they want to do. And so it gives them a lot of flexibility, which I argue is not a good thing. But that is from their perspective, that is, one of the reasons they exist. And another thing is that they would deny that. So most central bankers, if you ask them, is one of the reasons you exist to fund the sovereign, almost always they would say no. It's an uncouth thing to say. Maybe some retired central bankers tend to be a little bit more flexible with how they
Open-minded,
say
yeah.
things.
Yeah.
Not all of them, but some of them. So they would deny that. They would go on about how they're trying to run stable monetary policy. They want to make prices gradually more expensive year after year. And that's kind of their purpose. But behind the scenes, yeah, funding the sovereign is one of the apps, like the top 2 or 3 things that they do.
Would you say to the other points that they're raising, is there any merit to this? Like administering or managing the economy? So, or would you say it's all sort of also a consequence or ramification of them being there in the first place? Or is there any merit to the other arguments why central banks are around and what their sort of task is?
Well, before the kind of the modern era, so the post global financial crisis, they weren't necessarily funding the sovereign too much. Basically, after World War II ended, there's this long stretch where we didn't really have a lot of central bank directly funding of the government. Instead, it was more like managing these private sector credit things. Now, the big criticism is that they cause those cycles as well. They're not just so anything has cycles to it. So even without a central bank, cycles do come and go. There's just kind of human herd behavior that happens and momentum shifts and things like that. But then from their perspective, they're trying to kind of be counter-cyclical. They're trying to like stimulate during a downturn and kind of hold things down during a bubble. With the problem that their actions generally lead to the next bubble. So for example, after the dot-com bubble, well, actually in the middle of the dot-com bubble, when long-term capital management had an issue, they provided liquidity into the market. And then in addition, it was the upcoming Y2K issue, which is now 25 years ago, but people were worried about clocks, hitting 99 and going to 0 and causing an issue. So they were worried about outages and stuff. So they front ran liquidity into the market in the late 1990s. And that contributed to the dot-com bubble on the upside. Combined with the exuberance of new technology and everything else. So they weren't the only cause, but they just poured some gasoline onto the already raging fire. And then as the recession happened and as the dot-com bubble melted and everything, in something like 2001, they came out and cut interest rates all the way down to 1%. And they inflated a property bubble, which then blew up, 7 years later. And so they end up being more pro-cyclical, I would argue, than counter-cyclical.
This show is brought to you by NewHedge. In a market driven by complexity, insight is everything. NewHedge is a dedicated Bitcoin analytics and intelligence platform delivering cutting-edge analysis, on-chain metrics, and real-time market data. With 200+ proprietary indicators, live derivatives data, and adoption metrics, NewHedge provides the depth and precision that serious market participants demand. Backed by some of Bitcoin's most prolific investors, NewHedge connects traditional finance with Bitcoin's evolving landscape. Gain your data edge today. Sign up for free now at newhedge.io and get 50% off your advanced subscription with the code SIGNAL. Yeah, and to me, it feels really like in a fiat system, if we take this for granted, and it's probably just a reality that there is. Obviously, if you are also a sort of fiat economist, you can make a case, and I feel like, there is some task for them or some position for them to take. But exactly, if you sort of try to think outside of the box and also question them, their fundamental sort of role that they play, then you can come arrive at different conclusions. That's for sure, and that's always like a philosophical question, even in the end.
I think a lot of it is the sacrifice of the long term for the short term, which again they wouldn't agree with. But basically, they're always kind of putting out the current fire. So it's like if there's a recession, it's like the main thing is get out of the recession. If it's too hot, it's like suppress it. And basically, what they're always trying to do is make sure that total credit keeps going up. In my recent talk at the Bitcoin conference, I pointed out that, in like 100 plus years of history, there's only been 5 down years in the amount of total credit in the US. 4 of them were in the Great Depression. One of them was a 1% drop in 2008. And they just find that completely like impossible. So, they just jump in and make sure private credit's always going up, or the combination of private and public credit's always going up. So they're always trying to like pull forward stuff from the future. They're always trying to like, well, don't stop consuming because that's bad for the economy. It's like keep consuming. If consumption's too low, keep consuming. It's this kind of treadmill that they're always trying to keep the economy on. They would argue that the net positive of that is good, that the economy is faster because they're doing this, even they might have some flaws. Whereas critics, and I'd be more in the critic camp, even though I do try to steelman their argument to make sure I understand it, but the critic camp would be that it's more detrimental than not. And I think it ultimately comes down to most economists don't think that price controls are good. That the market should set prices, and what central banks do is they set the price of credit, and kind of more fundamentally the price of money, but basically the price of credit. And so their decisions, a small group of individuals, has rippling implications for the entire market. And every time they're wrong, that can affect millions of people. It's price control the most important thing.
Yeah, that's true. I mean, one of the underlying rationales for me is also, that they want to solve problems in the real world, and they really see themselves as a problem solver, even though sometimes they are the arsonist that sort of keeps the fire going or makes it even bigger. But then, I mean, it's really like thinking through this lens that they're fighting wars. Like historically, one of the major reasons, as we also established in the book, and many before us have done this as well, is like central banks have been providing financing to the sovereign king, like to finance their actual wars, and today it might not be actual wars, but I want to come to this in a minute, but also like wars against drugs, wars against poverty, wars against everything, basically. You can also see it sort of as a war, quote unquote. And so this is really why central banking is around. And as I said, the big corners themselves have like the dominant belief that today's central banking is really here to foster war making, and it even like it really fosters and promotes it. But however, if you make this argument to your typical normie friend, he's like looking at you as if you are sort of a conspiracy theorist, and he's like, what are you talking about? So I'd be curious to hear from you. How can we explain this rationale behind this argument in a most easy way? That there is sort of a connection, and not only from a macro point of view, because there I get it, but maybe more down into the nitty gritty as well.
So what I'd say is that even before central banks, kings have been financing wars and other unpopular things with debasement since thousands of years. Which is to say, if they want to spend something, so taxes are more transparent. The taxman comes to your place and says you owe us this amount, and this percentage, or whatever the case may be. It's very transparent, and so if you tax too much, you risk getting people in the streets. Either they vote you out if it's a democracy or republic, or they riot if it's some sort of monarchy or something. If it becomes intolerable, and so they don't really like to transparently do this. They like to defer the costs, make it invisible, and you figure out years later what happened. And the older technology to do that was literally debasement of coinage. You take the money that you're getting from taxes, which is you're still taxing, but you're just not taxing enough to do what you want to do, which is go war against the other guy. And then they melt it and they, reduce the gold content or silver content by like 10%. And then they are able to make 10% more gold or silver coins, and then they spend those in the economy. And initially they have like the same purchase value because people have this kind of unit stuck in their head, and they have certain wages and contracts that are already in place, and they pay their soldiers the same amount they paid before. But over time, as the money supply grows, there's more demand in the market, and then it pressures supply and prices start going up. So the kingdom benefits from seigniorage, meaning that they get to spend the new money first while it's still worth roughly what it was before. And so that's like an invisible way of kind of making the math work. And what fiat currency does, it just kicks that in overdrive. So if you look at how long it took Rome to like run their currency into the ground, it took like centuries. Because if you just take everyone's gold coins and you give them steel coin, not steel, but you give them like cheap iron coins, that's obvious. It's kind of a inherently slow process to debase in most cases, a physical coin. Whereas if everyone just has their money in a account, uh, whether it's gold backed or not, with a stroke of a pen, you can just debase everyone by 40% overnight if you want. You could cut the currency half overnight, which happens on a regular basis in kind of fiat currency history. So basically, fiat technology greatly boosts seigniorage, which allows the government to do things that they might not otherwise do. I think that the most tangible example I give, because it's the Iraq War is quite unpopular these days. We kind of look back and say, should we have done that? Probably not. It's different
Mm.
than the, war on terrorism and going after specific entities that attacked, 9/11 and stuff, but it's like, should we have gone into Iraq? Most people today are like, "No, that was a boondoggle." At the time, it had something like a 74% approval rating by Gallup and others. It's top of my head, it was 70 something. I think it was 74. And if you had asked them, "Well, are you willing to pay like a 10% war tax to go into this country that that more people were willing to invade it than could point to it on a map?" And if you said, "Well, there's actual cost to you. Like this is not free." Um, and most people said, "Well, no, I don't wanna pay for it." And so by basically just kind of running a deficit and then later monetizing some of it, it's something now we're talking about the deficit, but now all those people that made those decisions are out of office, there's no consequences. And so what debasement does, and fiat currency in particular does this, is it just kind of pushes the problems onto the next set of politicians and the next set of voters and says, well, they can untangle what happened later, or they can argue about whether it's Trump or Biden causing inflation, and we can ignore the fact that all this public ledger was put on, all this debt was put on the ledger by like Bush, because that it's just he's out of the picture now. So it just delays, it causes that big delay, which is helpful for leaders.
Yeah, and these are great points because they really hinge on what we also like established in the book. Because you're exactly right. I mean, it was really through taxes that these kings and sovereigns had to raise money. And there might be this other avenue of going on to a market and borrow the money. But then you also need lenders. And I think that's what you've seen throughout history as well. There were like these wealthy families that sort of lend money to governments and kings and sovereigns, but at some point even they were sort of fed up because they figured out, okay, this money is just splundered on wars, and we're not getting well off with this, like lending to these kings, because it's not a productive business to go on into war. And I think that's where we consider it such a pivotal moment, this founding or establishment of the Bank of England, because for us it is, when I was studying this, it was really the first time that like a stand like the state and the private sector also merged, in the sense that the state granted its money issuing authority to a private entity, sort of, which is then a hybrid. And the private sector sort of gave the reputable, credit-worthy credit that they have, from the private sector that they amassed maybe over centuries as well. And so you had this establishment where you brought both of these parties together, and then you could really tap into the pockets of everyday people, also with the development of the bond market, which was the central bank probably also very instrumental in. And it created this abstractness, as you said, like people couldn't really see through this anymore, that they're now sort of paying for it, but only indirectly, right?
Yeah, and I think part of why this works is because they're doing two things at the same time. They're solving an actual problem while also funding the state. So the problem that they're solving, this goes back to the speed of money and kind of how centralization solves frictions. Like if I want to send money to you, it really helps if we both have just bank accounts at the same bank. So I can just like say, hey, debit my account, credit his account. If we have different banks, and our banks need to be able to do the same thing, they need to be able to go, instead of like, figuring out how to like settle with every other bank, it's really helpful for them to just have an account at like a super bank and be able to be like,
Mhm.
okay, well, credit this and add to them, and it takes 2 seconds. And so like the speed of commerce increased, and it started before the telegraph. It started with things like the printing press, just general faster communication in general, but printing press, the invention of paper, basically more affordable ways to make various kind of ledgers, more or less. That sped up commerce, so they all wanted to basically have these efficient ways to transfer stuff, and so they can come in, swoop with a problem, and say, "Well, this consortium of banks." now endorsed by the nation state, is like they'll be your big settlement ledger to help this go a lot more smoothly, and it's solving an actual kind of constraint in the market. And then the cost is that, when the government needs something, I mean, this obviously this consortium of banks or the central bank is going to assist because they kind of have to now. And so that's why I argue that it's not like it's not an accident that this all didn't happen 500 years ago. The technology just kind of wasn't there for it. But as the printing press, and especially as the telegraph came, these things just the incentive structure put it all in their court, and then they took it. They took advantage of it, and that's the world we live in. And then now we're in kind of this like nation state funded period where seniorage is a really big part of government expenditure, even though it always was. It's just a bigger percentage now.
Yeah. No, definitely. There's definitely 2 points to this coin for sure. I mean, on everybody's mind currently is obviously also the conflict in the Middle East, that's sort of boiling up again with Israel attacking Iran and vice versa. How can we apply this to this argument, that the Bitcoiners make, that central bank is really enabling war making? Is there a connection there as well? Or would you say, no, this is really just more religiously and ideologically driven, because it's been going on for centuries, I guess, and obviously now that Israel is forming its state, which is a sort of a younger phenomenon, it's gotten more prevalent, but maybe there's other roots to this. What is your take there?
Well, so I mean, this particular issue, I mean, it's been going on since the Crusades. It's kind of that clash of religions, and then more recently, it's land as well as religion. So it's often not even the religion itself; it's often land and identity. In the modern time, it also ties into just colonialism, where there's this period of time where the West would just kind of like put borders wherever they want in the developed world, and kind of do things. That was kind of it was founded back in that era. I mean, the conflict that's happening today is at a scale where these things can happen even without fiat currency, which is to say, a really big entity can back an entity that it wants and fund it, and it's kind of a drop in the bucket in the grand scheme of things. It's kind of the nature of empires. So even before fiat currency, Rome could have done something like this, and but yeah, it's certainly kind of when it abstracts the cost, it's easier to justify things compared to when there's a more tangible cost and there's a more actual risk of nominal default or having to run austerity, because when a nation has is liabilities in their currency that it can't print, it's actually scarce. And so the ability to kind of invisibly diffuse things throughout the public, whether it's supporting one side in a war, whether it's running a stimulus program that they claim kind of has no cost to it, or it's not a big deal, by kind of deferring consequences, big or small, it just kind of gives more power to politicians.
Yeah. Yes, I see. Some Bitcoin, like the flip side to all of this is obviously, and some Bitcoiner argue that way, is that a further Bitcoin adoption would make fiat debasement less probable, and then sort of everything more transparent, costs more tangible, more direct, and thus war less likely in this more Bitcoinized world. And so theoretically, this sort of makes sense to me. But then if I look into the world, and we're now 15 years into the Bitcoin development, empirically, there's not much that supports this, I would argue, or at least I don't know how to quantify and maybe test this theory. So are we still too early in this journey, or what is your sort of belief there?
Oh yeah, Bitcoin at 2 trillion market cap is completely irrelevant for nation states being able to engage in war. We live in a world where there's about 1 quadrillion in total assets. So it's like 1,000 trillions. And the U.S. bond market is 36 trillion right now, 37 trillion. Global sovereign bond markets are tens and tens of trillions, maybe 100 trillion. Global money supply is over 100 trillion. Bitcoin's a drop in the bucket. So right now, doesn't mean it's not solving a problem. I mean, if someone gets locked out of payment rails, or they want to hold money that's not being debased, it's serving millions of people. But it's at its current scale, it has very little impact on nation states. Nothing short of being like 10 times or more bigger would start to affect that. Basically, when a meaningful percentage of the population would rather hold Bitcoin than hold a fiat currency, that's when it starts to matter. When it starts actually taking away seigniorage from the nation state, which doesn't happen at a $2 trillion market cap today. That's 0.2% of global assets. You need to start getting into the whole integers, at least. I mean, ideally double-digit integers. So basically, until it's kind of like a new foundational type of money at scale, then yeah, it's a different discussion. And these things inherently take time, but you're going against an absolutely massive network effect. This is it's both a self-sustaining network effect, and then it's also a nation-state endorsed network effect. So it's absolutely massive. And this like open source network has to bootstrap from zero, and to the extent it's successful, it's going to take a very long time, and it can even take so long that people have to just kind of grow up with it, and it's around rather than making the active decision to transfer to it.
And would you feel we will ever end up at the point where Bitcoin would really be having this impact and influence? Because, like, I'm asking if I put on, I'm surely a Bitcoin bull, and so are you and others. But I mean, like, if I put on my fiat hat, I feel like, yeah, the incentives are very much stacked up against Bitcoin as well. Because like countries don't really want to lose being monetarily sovereign. And so, I mean, I'm also picturing a world where maybe not all the countries are simultaneously moving on to a Bitcoin standard. And then you have one country which is on a Bitcoin standard and the other one is maybe still on a fiat standard. Wouldn't the country on a Bitcoin standard constraining itself be sort of at a disadvantage when it comes to war then as well? And so I feel like I want to believe it, but I'm really not sure if we ever get there.
Yeah, I think it's a good set of questions. One is I wouldn't take it as a given. It's hard to predict exactly how large it's going to get. One thing I like to reference is Jeff Booth. He often phrases things as if Bitcoin stays decentralized and secure, which is basically, so we're 16 years in this technology. It's been tested in multiple ways. It's very anti-fragile, but it's not necessarily invincible. So to the extent that Bitcoin as a network is not kind of corrupted, captured, neutered in some way, as long as it just kind of keeps functioning the way it has been, I expect it to keep taking market share up to a very high level because it's as fast as fiat currency, but harder than gold. As long as, again, it continues to operate the way we expect it to. And so I do think that eventually it does eat into major nation state seigniorage. Whether it's 100%, like it just completely invalidates the existence of fiat currency, or if it takes like half of it away by basically constraining them more, by giving them a much faster alternative that people can go to. That remains to be seen. We already, the closest thing we have today is like dollarization. So if a country just manages its currency terribly, people dollarize from the bottom up. They find ways to get dollars and other assets, and everyone learns you just can't hold currency and bonds of this country, and so that country massively loses a lot of its seigniorage. And then extreme examples, the nation state itself will give up and just say, okay, we're gonna use the dollar as our currency. That's happened to a handful, and Bitcoin can do that to stronger currencies over time when it's bigger and more liquid. So we have a model in place, and we have this kind of long-term incentive to. There's really no reason to hold currency or bonds other than either one as the near-term working capital, like your checking account, basically to kind of pay bills in the current fiat era. It's like a hot potato. You use fiat currency, but don't really hold fiat currency. Or if you're a trader, sometimes it's a volatility reduction. That's why it's still useful because it's stable, at least developed market currencies. So if you want to reduce volatility, it can be useful. But for the most part, it's not that useful. And as Bitcoin gets bigger and less volatile, it keeps eating into the reasons why you'd ever want to hold fiat currency for more than just a couple months worth of capital.
Yes, that's a great point. And I also feel like these countries that dollarize that you mentioned, it's probably not that they do this on their own terms, so to say, or because they want, but it's because like reality is sort of forcing it upon them at some point. And that's really the question, if that will ever happen with like more established, developed like currencies as well. And so, yeah, this is probably up for grabs, but history has shown that every now and then reality really forces itself upon even like the biggest nations. And so it's definitely possible, right?
Yeah, I think, I mean, entities like the US and China have more runway than, country XYZ that's a tenth of the size and more externally vulnerable. But the longer this goes on, the more indebted these sovereigns get and the less kind of reliable the currency is. And then the longer Bitcoin's around and trusted and understood, um, then the memes start writing themselves. Like, it just becomes understood that holding bonds and currency for the long run is stupid. Uh, and you have to hold scarcer things. And then it becomes, okay, what is the best scarce thing to hold? Gold's an option. It's a good option. Equities are an option, depending on what country you're in, what access you have, and what their current valuations are. And Bitcoin is so far an amazing option. And so I think those things will eat into currency and bonds. And Bitcoin has the additional advantage, unlike equities and gold, that it can be used for money in the digital age.
Mm, yes, I see. I also feel like for this transition that we're discussing to take place, government debt in and of itself would really have to change, or at least like the status, because like that's something we researched in the book extensively as well. And it really dawned on me when I was doing this that like government debt, even though it's debt and it's a liability, it almost feels like it has this asset status, and there's like economists from Germany, Heinrich Rittershausen, he has like really written about this extensively, saying it's so weird and even like in some sort of magic trick that happened here that at some point government debt became really an asset, so to say, and now then obviously got this reserve status. And so I don't know if you have any thoughts on this, because it also feels like to us who have grown up in this system, it's just ever going to be like this, But it's just amazing that this could happen in the first place.
Yeah, and I think, I mean, again, a big chunk of why I think it happened is because of the speed mismatch. So basically, the world became able to send IOUs around the world instantly. Gold was still very slow, so they levered it 20 to 1, basically, and then they just kind of dropped it entirely. And people went along with it. And even today, when currencies fail, people generally dollarize, not they don't, like, start
Mm.
trading around gold and silver as frequently. In extreme examples, they do, like Venezuela, they'll use a combination of, like, dollars, local currency from neighboring countries, flick, like, little pieces of gold and silver. They'll use kind of whatever they can in extreme environments. But basically, it's just not solving a fundamental problem for them, gold and silver. And so people want the speed of other things. And so I think that's kind of the technological era that we're in, as weird as it is. The example I like to use sometimes is when people invented farming and we transitioned from, like, hunter gatherers to like farming and cities. Most evidence indicates that the average life expectancy went down. Uh, so there's a trade-off that the ones that were, like, farming, they had more overall power because their numbers were incredible and they could just displace the hunter-gatherers, and they were able to, some of the people were able to start working on tools full time, and then technology kind of started building very quickly. So the civilization got a lot of power, but for the average individual, like, their teeth were rotting, they were just not as healthy, they were now crammed together and getting disease in a way they didn't before, as frequently. And so it actually was like a lower quality of life. And this lasted for, like, thousands of years until they, discovered hydrocarbons and use it to make, like, running water and, like, all and electricity, and then, like, basic medicines and germ theory. And then they kind of got out of that slump, that multi-thousand year slump, and they actually got life expectancies kind of really, really high, higher than they were in the hunter-gatherer era. And I think we're in that kind of valley now, where when you get something that comes before something else, if you invent farming before you invent running water, you're gonna have a rough time for a while, even though it's like a thing you have to kinda go through. And when you invent fast transactions with the telegraph, but you don't have fast settlement until Bitcoin a century and a half later, you're gonna have a problem. And you solved one problem, but you invented another for yourself. That's the world we live in. And even though Bitcoin exists now, like I said, when it's under a $2 trillion, um, you know, market cap or so, it's still in the nation state's court. It's still the central bank's court right now. So it's still, until it becomes so big that it actually rivals the size of that existing system. We're still in that era where most people are on a fiat standard. And so we're in that kind of valley. And so in that valley, things can seem unintuitive, like people living less, like shorter lives than their hunter-gatherer counterparts, despite having ostensibly better technology. And today, it's like, why are we using government debt as assets? Well, because we're in this weird valley of time
Mm.
where they can justify it.
Yeah, exactly. That's always a great thing to do, to sort of zoom out and then also see again, that things have been extensively different in another period of time, I guess. I mean, even with the book, that's something we figured out as well when it comes to these US treasuries. I mean, it's fascinating that today, like stuff like a Bitcoin strategic reserve with a government is being discussed, or like bit bonds, like Bitcoin even serving as a sort of collateral for US government debt. But I mean, in history, as far as I was informed and I researched it, it feels like this has been the case in some point in time, or at least what I researched is even that before 1922 or something, US treasuries were even not allowed to be sort of backed, quote unquote, by US treasury, or treasury. The currency was not allowed to be sort of backed by US treasury debt. There was like these real bills, some more sort of commercial paper that was more extensively used and stuff like this. And so I feel like we have the precedent for this, that we could go down this route again and have the dollar be stabilized by something other than treasury bonds only, I guess. Right?
Yeah, we absolutely could, the question is, where is the incentive there? Do any of the people that run the system wanna do it? And then even the voters, if they say they wanna do it, but then it's like, "Well, okay, so we're gonna do austerity now, and your Social Security checks are gonna get clipped." And like, "Well, no, I don't want that. I just want the good side, not the downside. I don't want anything to happen to me." And so between the voters and the politicians, the fiat currency debasement is kind of the release valve. So as they
Mm.
fail to agree with each other on how much to tax, how much to spend, the error just gets kind of invisibly debased and argued over, and kind of the impacts happen with a delay. So I think nothing short of a forcing function is needed, which is basically, it's going to keep happening until something forces them otherwise. Which is to say, until there's something really powerful in their face, like Bitcoin is 10 times bigger than it is now, or something. They're going to keep doing it.
Yeah, I see. I mean, obviously, bonds are also traditionally viewed as a safe haven in times of war and just turbulence and stuff, And I think you just recently posted that with this last sort of hiccup that we've seen, like the strength wasn't particularly great, in terms of like money flocking into government bonds. And I know you're not a doomer or a crash prophet, and so I mean, how do you put this into perspective? It's probably not the final call, but we're seeing just like incrementally, probably things chipping away at this monetary status and reserve status or asset status of these treasuries. So, how do you put this into perspective?
So I would say that bonds have been a kind of safe haven for a shorter period of time than people think. So if you go back, for example, from the 1930s all the way through the 1970s, bonds were like one of the worst things you could possibly invest in. Almost anything else is better than bonds and currency. It was like a structural, like a generational long bear market in bonds. Um, and sure, during brief recessions, in some cases they would do well, but other times they wouldn't. It'd be like an inflationary recession. And then from the 1980s through the 2010s, they took on this safe haven aspect, and that's the operating history for most investors today. So in current investing lifetimes, they view U.S. And other kind of developed government bonds as safe havens, which is long in the sense that it's like a 60-year-old or 70-year-old investment manager today. It's been throughout their entire career, um, but it's not really before that. And so, we grew up with it, or we operated with it. Um, and that regime can change. And I would argue that it already has, because I generally argue that we're back in an environment that looks more like the 1940s. I think we're starting another cycle where bonds and currency are just not defensive assets. They're more in the structural debasement period. From the 1980s, from that point, we had already, the bond bear market was so bad. They already got most of the purchasing power wiped out. And then we kind of reset with a very low debt level at the sovereign level, and to some extent the private level. So low debt, they were able to, in the 80s, run a very hard monetary policy, at least as far as fiat currency goes. And that kind of started the next bull market in bonds. But we've spent 40 years tapping into that, and now we're back into a state of high debt, which is generally a period of time where bonds and currency are not going to do well. And I mean, I wrote an article in 2019. Are we in a bond bubble? And kind of analyzed the whole thing and decided yes, we are. And it's been like the worst 5-year period for bonds like in history. Like it's been catastrophic for bonds versus every other asset that you could almost possibly own. And I don't think it's maybe going to be as bad, say, the next 5 years as those 5 years. Like that was like unusually bad. Um, but much like the 40s or the kind of the late 30s through the 70s, I think we're in a more structural period of just bond just not being great anymore.
Mm. Yes, I see. And maybe related to this, a question on treasury bonds is really like the treasury bond buyback programs, that we've been seeing. And I think you commented on them as well. And sort of my question would be, is this really a way or a means for the traditional system to now fence off any sort of bubble from really bursting like badly, or is this just traditional liquidity management? Or again, here, how are you thinking about this? Because obviously some people within the Bitcoin sphere also call this money printing, even though it feels like just like an asset swap. But then, yeah, how do you think about what the Treasury is doing with these buybacks?
Well, so it's very different than QE. QE is money printing. Now there's certain qualifications to that statement, but QE is money printing because, and some people will say QE is just an asset swap, but they create money and then they swap it for an asset. So it's an asset swap with one side's being created out of nothing. So QE is money printing. Um, Treasury buybacks are not. They're issuing newer bonds and they're retiring older bonds prematurely. And so that there's no net money added to the system. Uh, and so I think overall it's getting more attention than it should. It has, not to say that it's irrelevant, but it's kind of being overly focused on. But the implication that it does have is part of why treasuries are going back to the prior question. How do treasuries get to the heart of the system? It seems kind of unintuitive. It's because they've been like the biggest, deepest, most liquid market compared to most other things. It's also, I mean, the dollar itself is a very deep and liquid market, and then treasuries are a very deep and liquid market. In recent years, that's becoming less true, which is to say that the one way of measuring this is the total size of the outstanding of U.S. government bonds has increased faster than the daily, weekly, or monthly trading volume of bonds. And so, if you're a big bond holder, especially longer duration bonds, like if you're a big insurance company or a bank or asset manager or sovereign entity, some sort of big entity. If you want to be able to sell, just like snap your fingers and sell $1 billion of bonds like in the hour, or sell 10 trillion that day. I mean 10 billion that day. It's now not necessarily liquid enough for you to do that without moving the price. So kind of the whole selling proposition of why bonds are so great is impaired if they're not very liquid. And part of the reason they're not very liquid is because there's not just one type of treasury bond. There's multiple different durations of bonds and a couple different types, like inflation protected or not. And so the liquidity is fragmented into a handful of different buckets. And a lot of those buckets are not as liquid as market participants would like. And so one of the band-aids that they can do is come in and say, okay, so we'll buy older bonds from you. We'll inject liquidity by issuing newer bonds, and that's not net money printing, but it is showing signs of not a particularly healthy market. It's kind of like if there's a popular trading card game, and over time liquidity kind of dried up, and it was hard to kind of there wasn't big volume for buying and selling. So then the company that issued them came in and decided, okay, we'll run a big exchange and we'll buy them back and resell them and we'll try to smooth over the low volumes that are happening. It's not a great sign. So I would say there are implications, but it's not the same as money printing.
Yeah, then there would be a sign of something is sort of sketchy and maybe even off. But I mean, I feel like there might be indirect consequences or ramifications, when, for example, you know this better than me, but if they were not swapping these assets sort of duration for duration, if they were maybe doing, I don't know if they do this. Is this mostly that they swap a bond for a bond and not a bond for a bill, I guess, right? That's not what they're doing. It's really duration for duration. in the
So
end.
if they meaningfully shorten duration, which happened under Yellen, even before they were
Yeah.
doing buybacks. So it doesn't you don't need buybacks to shorten duration because you can just let older bonds mature and then issue newer debt with shorter durations. So it's almost a separate question. But you can accelerate it if you then also buy back old like longer duration existing bonds and issue T bills to do it. Um, if you meaningfully shorten debt duration one way or another, that does that has kind of pro liquidity ramifications.
Mm.
That's something that emerging markets do. During extreme currency crisis, like Brazil went through this, like who would want to own a 5-year Brazilian bond if they're having super high inflation, which they did, decades ago? They'd they'd have to kind of like issue most of their debt like overnight, just really low duration stuff. Um, and so it's a sign of an unhealthy market, and it is a way of kind of you know more liquefying it because it's way easier to hold a T bill if you're a bank or something, or even an individual than it is a T bond with all that volatility risk. So that would be more direct intervention. At the current time, they're not dramatically reducing their average duration, but they did that over the past couple
Mm.
years. They might certainly do it in the future. Right now, they're kind of in this holding period.
Yeah. Maybe just one last point, because like another way where I could see this sort of not being money printing sort of, but maybe having this stimulative effects would be if you were sort of retiring bonds and now reissuing them with a higher interest rate, because like interest rates have maybe also moved. And then obviously the newer bonds that sort of come online would have a higher interest rate. And that would then, I think you alluded to this as well already through this interest rate, MMT channel, like more money would end up in the economy because the government would have to pay now higher interest rates on these new bonds. I mean, that's probably not their goal, but I mean, if interest rates are higher and they sort of have to do this, by buying them back, but then issuing at a higher interest rate, then that would also have sort of a stimulative effect, wouldn't it?
Yeah, to some extent. Yeah, absolutely. And that's actually one of the issues where, um, because we're no longer in a structurally declining interest rate, things start working differently than investors have been used to for their entire investing career. 40 plus years of structurally declining interest rates are over now. And so even if they're not going structurally up, if they're just going structurally sideways, we're in a new environment. And so it's not like, it used to be that basically all new issued bonds had lower interest rates than older bonds, and we're not in that environment anymore. Now the amount of buybacks that they're doing relative to total debt, I would say, are not moving the needle a ton on total interest rate compared to just the amount of that's outstanding. If you're doing tens of billions of buybacks and there's tens of trillions of debt outstanding, it's not like you're meaningfully changing the interest rate profile, which is why I think that overall this topic currently gets more attention than it probably deserves compared to other things that are happening. Not to say it's irrelevant, but yeah, that's certainly a factor.
Yeah, I think that ties well into the last point I want to cover with you. I think we have a couple of minutes left, and then because one of the central themes we explore in the book as well is really where is the fiat system, if we want to call it like this, headed, and sort of the argument that we're making and others as well is like we're seeing this environment where there's like the signs of late stage fiat, and it's characterized by exponentially rising debt. And I think obviously you've made that point as well. And so I think we will probably end up just defaulting, or more likely in countries that we're at in the US or maybe other Western countries, that it's default by the basement. I think that's how you called it as well. So would you argue that we're seeing this late stage fiat signs that they are all over the place?
So I think at the very least, we're in the later stages of a long-term debt cycle, which is to say the way that generally works is you build up a ton of debt in the private sector over decades. Every time there's a problem, you lower interest rates and encourage that debt to keep going up again. Because again, central banks, they pull forward stuff. They want to put out the fire in the short term. When you hit zero interest rates and private debt levels are super high, there's really nowhere else to go. And so then you start to get more fiscal response. And it's accompanied by central bank money printing. And what happens is that you rotate some of that debt onto the sovereign level. So you deleverage, not necessarily nominally from the private sector, but as a percentage, and you push more of it to the sovereign level. And then it really has nowhere to go other than default, or if it's in their own liabilities, then print and debasement. Um,
Mm.
and I would argue, I mean, we're 5 years into that. I mean, this has been a catastrophic 5 years for purchasing power of bonds and currency. I think we have much longer to go. Now that you can kind of do it all at once with like very high inflation, or you can do it over a prolonged period of time, or a combination of both. You can have like a prolonged period and then a sharp kind of rip the band-aid off moment. Um, and so I do think we're in the later stage of a long-term debt cycle, which is basically where currency takes the brunt of the impact more so than, say, private sector nominal defaults and things like that. Um, Whether it relates to fiat or not basically comes down to the question of whether there's going to be another long-term debt cycle after this, or if technology will have transitioned enough that there's viable alternatives at scale, which goes back to the earlier point. So if this happens while Bitcoin is worth $1 trillion or 2 trillion, then yeah, we probably kickstart a whole nother cycle. I mean, if it gets bad enough, nation states could back their currency by some degree of gold. And so you have a kind of debasement. Yeah, as things are just kind of getting out of control, they kind of manage to solidify it, kind of like they did in the 80s. And basically kind of just, you burned off a lot of debt, and now you kind of like stick the landing and harden everything and kind of try to rebuild trust. And that can work for another couple generations. Or if Bitcoin's really big by the time we get to that point, then it more permanently solves the issue that the telegraph opened a century and a half ago, and it becomes less viable to even hold central bank, nation state issued assets. Because if Bitcoin's a really big global settlement network, and it's really liquid in multiple currencies, and you're a central bank, why would you hold dollars and treasuries, which are debasable and confiscatable, when you could hold Bitcoin and you can still move it around as quickly as you could treasuries? But it has to be at a scale and a lower volatility that would interest them.
Mm. Yeah, very interesting. I mean, in the book, we talk about this as well. It's sort of the $1 trillion question, no pun intended. Like, when does it end, or does it even end? And I mean, we flirt with this theory, that the fiat system will run long, or can stay, will run longer than you can bet against it. And the thing is, like, as you said. As you said it earlier in the interview, there's still a lot of room left for central banks to really, there's balance sheet capacity to have this run longer and have everything be transported and to the central bank's balance sheet. And so it's more of a endless horror, so to say, than like a horrible end and hard stop. And I feel like there's also ways with regulation that you can sort of soft force people into holding on to these
Yep.
assets. And so I can't shed the feeling that we're moving into sort of these a two-tiered system, where you have maybe a system, Fiat 2.0, that's moving into even modern monetary theory, and is going to endorse this at some point, like outright, and then central bank digital currencies come in that maybe give the government another lever to control things. And then you have Bitcoin on the side, as another sort of system that people can flee into. So I'd be curious on your thoughts. MMTs, essentially CBDCs, is that part of the fiat endgame as well?
I do, and there's a couple parts of that question. We can kind of take them piece by piece. Um, uh, in general, I agree that it's going to go on longer than people think. Part of my phrase "nothing stops his train" is basically saying it's saying two things. People have to focus on the first half, which is deficits are not going to go down meaningfully anytime soon. So nothing stops the deficits. But on the other hand, if I thought this was going to hyperinflate in 3 years, I mean that stops the train. And so my view is it's also on the other side. It's going to be more long lasting than many people think, because they're also not going to completely go off the rails in, call it, 5-10 years. I mean, you look how far enough, things can happen. But in any sort of like investable time horizon, they're in this kind of weird middle ground of running things hot but still moving forward. They have a lot of tools, and they have a lot of network effects to kind of keep that grinding in place, which include, it's not to say there's no consequences. There are people facing the consequences of that, but it just means that it's not spiraling out of control in that near term or intermediate term. Um, and the question of when does it end? I would say the beginning of the end, or the meaningful shot at the end, is when there's an asset that is liquid enough and fast enough. Um, and Bitcoin's not there yet because it's fast enough, but it's not yet liquid enough. It's too small, which it has to go through this period to get to that bigger stage if it's going to get there. So when something can rival the Treasury, it basically can mimic all the traits that the Treasury has, which is a nation state or any sort of large balance sheet in the world can hold it. They can send it around just as fast, and yet it's they trust it more. It can't be confiscated from them, and it's not going to be debased. They understand the code. It's not like as volatile anymore. When it has all those traits, then it starts to become, why would I ever hold treasuries? Because I'm
Mm.
not in your walled garden. I'm, China, or I'm India, or whatever. Like whatever, the whole world can just say, I don't want to hold that country's debt anymore because it's just no longer solving a problem that it did before this existed at scale. So when something is liquid and fast as a
Mm.
treasury, it's a problem for the treasury, which we're not there yet. As far as CBDCs and walled gardens and stuff, I do think that, I mean, that basically, in terms of one, transparency, so fiat currencies surveil their users, and over time they keep adding new layers of surveillance, and the capstone is CBDCs. Um, and so I do think that that's kind of the end game there. And then as sovereign debts become issues, they do tend to turn to financial repression, which is, I mean, back in the 40s, it was extreme. In America, supposed land of the free, for 4 decades, it was illegal for Americans to own gold. People still did,
Mm.
but it hurt liquidity, obviously, because it's on the black market now. Um, and so you couldn't own gold. Nations around the world had capital controls in place, and basically bond holders and currency holders got completely rugged. But one thing that's different now, and they're absolutely going to run those types of playbooks. They already are to some extent in a soft way. The difference now is that information goes way faster. So before, uh, you know, while that was happening, people weren't like online memeing about it. It was like you'd kind of like get the Wall Street Journal, and you get there's more centralized points of communication. What's happening? Information flowed slower and in analog ways, um, and now is way more distributed communication. Information travels an order of magnitude faster, um, and so this can spread. Doesn't mean it spreads instantly. Not everybody hears it at the same pace that others hear it. But it's just much harder to run these playbooks and control the narrative in the way that they could before. And so I think that shortens it, kind of impairs the effectiveness of financial repression in a way. It doesn't make it completely ineffective, but it makes it puts it in hard mode for them. And so the combination of having new monetary technologies that can rival the value of the treasury, and two, faster communication to talk about the problems of the treasury, makes it harder for them to run that same playbook.
Yeah. No, that's these are great points. I mean, in the end, I really feel like there is a world where like MMT, CBDCs, Bitcoin, they could all, at least for the time being, sort of coexist. But as you said, I mean, that's the epiphany I had as well. Like Bitcoin is really fast enough, because of its technological foundation, but then it's also liquid enough because it's hard money that like everyone is turning to increasingly. And then it is really the case that Bitcoin, you could even argue, is the best thing that could have ever happened to fiat, like because like it's there to paradoxically make fiat great again and really be this sort of thing where the entire current system can hyperinflate into to some extent also into other assets, but because of the other two aspects that we just discussed, Bitcoin is just the best tool for this. And so yeah, I mean, even though some Bitcoiners might not be sort of fond hearing this, I feel like, yeah, maybe Bitcoin will make fiat great after all.
Yeah, I mean, I'd phrase it somewhat differently. Not to say, I don't think it makes fiat great, but basically, I do think it's going to coincide with fiat for quite a while. Obviously, certain nation states that hop on board earlier can massively extend their runway for how they do things. Because if you have a giant sovereign wealth fund or a giant, central bank reserve asset holding, then you've got way more ammo to run your fiat currency with. So certainly the subset that are early, it could benefit them. But basically, yeah, I do think that these things are going to run alongside each other for quite a while. And that's also why I think education is important, because one of the tools that central bankers and nation states will do is try to demonize Bitcoiners. to say this happens in developing countries. They'll say entities are attacking our currency. It's patriotic to buy our currency. It's like, well, maybe you shouldn't be growing the currency supply by 30% a year, right? Maybe that's your problem. Um, and there's always a grain of truth to these things. So there are when a country is running its currently poorly, outside people will come in and say, well, I mean, if you're gonna run terrible monetary policy, I'll borrow that currency and buy harder assets with it. And that accelerates the problem. But it starts with the fundamental system itself not running well. So they'll kind of drum up support and say, oh, our currency's it's not our fault. The currency's bad because external speculators are attacking it, and so we're gonna ban them from doing this, or we're gonna and it's important to have education to say, well, look at the money supply, look at their policies. Here's how you can protect yourself. And so as nation states kind of, run MMT and CBDCs and keep debasing and kind of going all the excuses for why they have to do it, and Bitcoiners are getting, rich because of it, or even gold holders are getting rich because of it, there are going to be attempts to be like, well, they're the bad people because they're not participating in our system and they're, greedy, they're hoarding. That's another word. They like hoarding. They're how dare they retain value that they worked for and not get rug pulled over time. And there has to be education to say, here's why that's not the case. You don't want to be outnumbered 99-1 in this type of system. And so it's part of why I do the work that I do.
Yeah, exactly. And that's so much appreciated. And thanks for everything you do. And obviously, that's why you've written the book. And I hope we can contribute to this as well with the little book that we've written. And so, Lyn, thanks a lot for doing this again. I think I've got to ask everything I wanted to ask you. Just thanks a lot for coming on, and hope to see you soon again. And have a great day, rest of your day, so to say.
Yep. Thank you for having me, and congrats again on your book. Good luck with it.
Thank you. Bye, Lyn. Have a good one.